Hi, I'm Ben Tafoya, and I'm back again with another episode of 5 o'clock macro. It's a little bit later than that this evening. It's Sunday, May 10th, and the weekend's given me some time to think about a couple of issues that I wanted to discuss tonight in what I hope will be a single part discussion of the macroeconomics of the economic crisis brought on by the reaction to the coronavirus. Um, so, so tonight I'm going to talk a bit about borrowing and review a couple concepts related to monetary policy. In the U.S., monetary policy is carried out by the Federal Reserve, and at base, in the past, what the Federal Reserve did was um, it created money to buy debt instruments, or it took money that it had in its own balances to buy debt instruments that were offered by the market. For the longest time, they were really limited to buying government securities. And so typically, the Federal Reserve's main policy tool was the federal funds rate. Once upon a time, they were also concerned with the discount window, but that's really not used very much anymore. So it's the federal funds rate, which is the overnight lending interest rate that commercial banks charge to one another for this very short term borrowing. And so the Federal Reserve would buy and sell securities in the market depending on whether it wanted to lower interest rates, that's when it bought securities, or if it wanted to increase interest rates, which is when it sold securities into the market. So for the last crisis and this crisis, the Federal Reserve has been very active buying securities to try to drive down interest rates. Um, the to review again, the significance of this would be that by driving down interest rates, that would spark more investment in the economy and would help GDP that way. But much of the Federal Reserve action from the 2008 crisis and from the current crisis of 2020 was to make sure that the financial system had all the liquidity it needed in order to function. Remember, in 2008, much of the crisis centered around financial institutions. So the Federal Reserve expanded its portfolio, if you will, of securities that it would put on its balance sheet to include mortgage-backed securities and various other kinds of securities. It created these sort of very special funds to trade in these securities. They were called maiden lane, or these special vehicles to buy the securities. They held on to them largely to maturity, took that money, and any profit the Federal Reserve makes, interest that it earns off of owning securities, much all of it goes back to the Treasury to sort of help the government revenue picture. So we saw from a historic period where it was just buying and selling government securities to the last crisis where it added to its portfolio. It engaged then in what was known as quantitative easing, which was this idea that they would buy securities throughout the various time frames. They did Operation Switch to try to also influence longer term interest rates. And so the basic tool set of the Federal Reserve, however, has always been pretty consistent. It is dealing with government securities. This time out, however, the Federal Reserve is adding to its tool set and doing things that it hasn't done before. So the question becomes, has the Federal Reserve moved from being the main actor of monetary policy to being also a major actor in fiscal policy. The advantage of having the Federal Reserve carry out these economic actions is that there's no political delay, and the recognition delay for crisis is pretty short for the Federal Reserve. So they're right on top of the stuff, and generally speaking, have a pretty good idea of what's going on in the economy. So once the crisis hits, they're not the greatest at figuring out the crisis ahead of time, as we saw in 2007. But once the crisis hits, they're the ones who get a quick indication because of changes in liquidity and other kinds of changes in the debt markets that provokes it to act. And there's a very short administrative lag for the Federal Reserve to act when it's committed to a course of action. So this time around, they were basically given the authority, and Congress appropriated money, for instance, to generate what's called a temporary corporate and small business liquidity facility. This is separate and apart from the actions of the Paycheck Protection Act. This is a pure play, basically, by the Federal Reserve to lend money through U.S. banks to small businesses and mid-sized companies in order to help keep them afloat during this crisis, so that they have some money to operate under. Again, this is a sort of step beyond where we have been in the past. It's an indication of the extraordinary nature of this particular crisis, as well as sort of advanced thinking and willingness of the Federal Reserve Board of Governors to take extraordinary action. Additionally, this time, the Federal Reserve has indicated that it will buy corporate securities that are what we colloquially refer to as junk bonds, meaning these are the debt instruments issued by corporations that have the lowest ratings. They're below investment grade. So these would be the kind of things that folks would buy only if they're looking for very high yields. And the Federal Reserve is stepping in to buy junk bonds, basically through exchange traded funds, to, again, help make sure that firms have access to the corporate lending market, even when there's a giant interruption of the economy going on. The Federal Reserve this time as well will also buy state and local municipal bonds. This is to try to help smooth the way for municipalities who are borrowing money. Now, keep in mind, municipalities and states typically don't borrow money to fund operating costs. They borrow money to fund their capital programs. However, there are needs periodically, because sometimes when you borrow, you don't actually borrow formally with like a 10-year or 20-year term and pay principal and interest every year. Sometimes you do what's known as a revenue anticipation note or a bond anticipation note, which are things where you're paying interest only, and you're looking to, at some point in the future, then put it on a permanent basis. And what you want to make sure of is that there are funds out in the marketplace to help municipalities do this, so they can roll over these obligations. Because if you have, if you're a small city and you have $10 million worth of bonds coming due that you had on a one-year ban, you would want to make sure that it could get properly funded, so that the amortization schedule is set up to be the least sort of disruptive cash flow process, given the difficult budgetary times that we're coming up with. So we had some interruptions in February and March of the municipal bond market as interest rates were falling very low. There were some times when it was difficult for the traders to sell state and local bonds because of this aggressive Federal Reserve action. It has eased up pressure in that market, and we're seeing extraordinarily low rates for borrowing by state and local government, but it is, in fact, possible. We're also seeing at this time borrowing by large corporations. There was an extraordinary story that was on the wires. I grabbed this one from Bloomberg, talking about different companies that have been trying to go out and borrow money. The companies need money to tide them over. They're not borrowing to fund capital investment. They're borrowing to fund ongoing obligations that they have. So these are very sort of risky offerings. United Airlines, as an example, had pledged collateral older planes that they had owned outright, and they were told that the kinds of interest rates that would be required to get people interested on a 10-year borrowing were between 10 and 11%. That's a very high rate of interest, given that the U.S. government right now can borrow for 10 years at about half of 1%. So this kind of borrowing this particular borrowing was canceled by United. But this particular article from Bloomberg talks about other firms, such as AMC Theaters, who was out looking for a significant amount of money to help them get through their particular cash flow crunch during this period of time, as well as Cruise Line that was looking to do the same thing. All of these businesses are hit hard by the evaporation of demand in their particular segments of services, transportation, entertainment, hospitality. And so in order to keep these firms going, because they have ongoing obligations, they're looking to borrow money to help pay the bills. So in the hierarchy of lending, this would be pretty risky sorts of lending opportunities. Now, it's understandable that they would have this cash flow need. And it's also understandable that many firms that have it aren't going to be able to secure the right kind of borrowing, and as a result, will have to shut doors. So we've seen companies that had already been laden with debt, J. Crew this week, Neiman Marcus this week. I would anticipate others in coming weeks are declaring bankruptcy because they're either trying to work through issues and emerge on the other side, or it's entirely possible that these things would get liquidated and not continue as ongoing concerns. But not surprisingly, given the state of the economy, we see that these kinds of corporate bonds have significantly increased this year. So this chart shows from the first of the year to the beginning of May, comparing each year since 2010, and you can see that the volume of this is extraordinarily high, both if you look at the dollar value of the borrowings that corporations are making, or the number of deals that they're looking to make. And all of these kinds of loans are secured by some sort of collateral, such as what AMC Theaters was doing with respect to its properties, or cruise lines were doing with their ships, or the airlines were attempting to do with their aircraft. So during this period of time, this kind of borrowing is very important, and the participation of the Federal Reserve in these markets is making it a little bit easier, or in some cases a lot easier. It wouldn't have been possible absent the intervention of the Federal Reserve. So the Federal Reserve is participating, and again, this is an extraordinary crisis. So the Federal Reserve is taking extraordinary actions, which we have never seen them do in the past. And there are some very interesting questions. And when we talk about sort of sources of information, which I'll try to do sometime in the next couple of days, some folks have pointed out the sort of difficult legal position that the Federal Reserve is in right now, doing all of this, these kinds of actions. But the fact of the matter is that the Federal Reserve does them because it's much easier for them to do them than the legislative and executive processes that are sort of in the textbook about how fiscal policy works. So we're still waiting for that next big proposal for federal government intervention, particularly the kind of massive intervention that we're going to need to help protect our states and localities. So thank you for listening today, and have a good evening.